Welcome to the presentation, the ever imminent market correction. And I want to just say from the outset that this isn't a comment about fundamentals. Some company fundamentals are pretty good and earnings is likely to be good. They might be trading on lower PEs. It's also not a comment about the macro economy, and it's really pure technical analysis. Technical analysis, pure and simple. To start with, I want to just make the comment about cause and effect, because most technical indicators are what we call lagging indicators. They're based on price. Price is something that's happened already, so it's lagging. Volume, on the other hand, is more of a leading indicator because it kind of tells you a little bit about sentiment and how many buyers and sellers there are in the market. So some say volume is the cause, price is the effect. And if we start just with that concept of volume, we can see that December and January have been pretty quiet months, particularly from mid-December to where we are at the moment. So volume has dried up, and it's not only on the all-share index. In fact, if you look at the volume on most global markets, you see the same thing. What's also interesting is that the all-share has obviously run quite hard. We've seen a bit of a bull trend, which we'll look at the moment, but if you look over here, a bit of a wedge is developing, and normally a wedge is an indication of a change in direction that's about to happen. So there are a number of indicators that we can look at. One is the MACD, or some people call it the MACD. I always thought that was a name for a burger, but the moving average convergence divergence is what this indicator is about, and it has two different lines. I'm not going to go into too much detail about it at the moment, but one of the things that one looks at for a change in trend is that the MACD moves in the opposite direction to where the price is on the actual chart, and so we see that happening. We also saw a recent crossover, and so that also indicates a change in direction. So the MACD is indicating that the market is about a change direction, and we know if we look at the market, we've come from a bull run, which we'll see in a moment. But just to confirm the stochastics tell you basically where the market is overbought or oversold, and at the moment we can see that the market is overbought. In fact, only from on the 10th of January did it jump down towards the oversold level, but then bounced back, and so since December, January, we've been really in overbought territory. What's also quite interesting, so the stochastics are telling us that, but now another indicator is the MDI or DMI rather, ADX. And again, this is an indicator that helps tell us where the trend is. If you look at between A and B, it indicated a very clear bull trend. The ADX line was above the two indicator lines, the D plus and the D minus. And in fact, the D plus was on the top, so that shows it was a bull trend. Between B and C, that trend started changing, and now after C, we're working in what we call a trading area of the market. So the market's directionless. It's not trending either up or either down, so we are in a trading market. So those indicators tell me that we're due for a retracement. How much? Well, that's where the Fibonacci retracement comes from. It's a very interesting indicator because it can tell you how much the market's likely to retrace by, and often it's 23%, 38%, 50%, or 62%. The retracement from the recent high and recent low. So if we look at the recent medium-term low, we're not going to take the low on the 10th of January, but we go a little bit further back, we can see that at a 20 or 38% retracement, you're probably looking at about just under 3% coming off the market. At a 50% retracement, 3.7%, and you're looking at about 4.7% on a 62% retracement. So that's why we say a 4 to 5% correction is very possible in the market. And these indicators are pretty realistic. They're technical indicators, but if we look at medium-term fundamentals, don't forget where we are in the economic cycle. Most markets have been looking for recovery, and they've been dropping interest rates as a result, and so interest rates are really at the bottom. From a global point of view, the next move is that most interest rates are going to go on the rise, and that may well happen in South Africa too. It's only just a matter of time. And so generally what happens is there's a move from equities to the safe haven of cash, because rising interest rates, while they might be good for financials and certain stocks, the market as a whole, it's not a good scenario. Encourage you to visit Share Tips. If you're a member, then you would be getting 2 free ebooks every month. If you're not yet a member, we suggest you sign up now and you can benefit from these 2 free ebooks a month. If you'd like to also just visit and give a 14-month trial, then somebody can refer you and you'd benefit from that 14-month trial subscription. Thanks for watching my video.